selling put options. That is what we're going to be breaking down in today's video. So hopefully by the end of this video, you'll have a good understanding on what it actually means to sell put options. We're also going to look at the pros and cons to why you may want to consider doing this within your own portfolio in your own investing strategy. Now, this is something that I've sort of known about for maybe about a year or so now, but it's only something that I've only really started implementing over these last couple of months, and now I've actually started selling put options myself through interactive brokers. But in today's video, we're just going to be focusing on the basics on what it actually is to sell put options, just so everyone has a very clear understanding on what actually it is to sell put options, as this can be a bit more of an advanced sort of topic. And if you're just starting out on your investing journey, I don't recommend you start looking at selling put options or even getting into any options trading in any other scenario either, as this is a lot more of an advanced sort of strategy for when you're a bit more further along in your investing journey. Selling put options is a strategy that a lot of famous value investors use, such as Warren Buffett, Phil Town, Matthew Peterson. And in today's video, we're actually going to be looking at a quick clip from Matthew Peterson, as he has a great explanation around how he uses selling put options within his own investing strategy. So let's jump over and check out Matthew Peterson around selling put options.
In layman's terms, a call option gives you the right to buy a security. A put option gives you the right to sell a security. And that's sort of option 101. We're flipping it over. A covered call would give you the right to sell a security, and a cash secured put would give you the right to buy the security, right? So you're transacting with an individual through the Chicago Board of Exchange. And the way that this is executed is through any broker, or I think even a Robinhood, an account, for example. You go in and you register as sort of a more advanced option expert. Sometimes you have to sign a document indicating you know how this is working. And then you're allowed to write these contracts rather than just buy these contracts. So you're able to sell these contracts. And I sell them as a limit order. So let's take Seritage as an example, since we discussed it a moment ago. And let's say hypothetically, I think the price might be at 10 now. So let's say the price is 10, and we sort of look at the value as maybe being up in the 40s. We may be willing to buy Seritage for 10 going out until October. And there are contracts that exist out until October and January. And so we would go in and we would specify the time frame. We'd specify the price we're willing to pay, which might be $10 a share. And then we'd specify the price that we would be willing to sell this contract for. And these prices are extremely volatile. So if we see that the market is sort of offering $3 a share for these contracts, we might just list it at 5. And I would put in a limit order and say, yeah, we'd be willing to sell you the contract to buy Seritage for 10 through October for $5. And if somebody bought that from us, I would be quite surprised. But it happens. And then we simply wait, until October when that contract expires. And if the price is above 10, we don't get to buy the securities, but we do keep the premium. So we always keep the 5. And if the price is below 10, we now buy it for 10, but remember 5 of it came from the counterparty. So we get into these stocks for a net cash outflow of 5. And so if the shares fall to 8, we're actually still up 60% at the time that we buy, because our net cash outflow was only 5. So how can this go right and wrong? I spoke on this. I spoke on this in Switzerland a few years ago, and so I sort of described it in these 4 buckets. The first thing is, the firm, which would of course be a terrible scenario, but it's a total mistake, totally wrong. Firm goes to 0, right? You sold some puts on Hertz, and it goes to 0. So that's a terrible scenario, of course. If it happened with Seritage, it would mean instead of buying it for 10, so you have to look at the alternative. Okay, if you were going to buy it anyway, and the market price is 10, you could buy it for 10 and it goes to 0. Or you sell the put contract, you get paid 5, it's falling, You now buy it for 10, which costs you net 5, and it goes to 0. So instead of losing 10, you lose 5. So it's not as bad as losing the full price of the equity, but it's of course a terrible scenario. Then there's the best scenario, which is the price dips a little bit right into the sweet zone between sort of the net cash outflow and the strike price, where you buy the security that you want to own. And that's the very best scenario. It actually causes volatility in the portfolio because these premiums can go up while you're holding them and you're essentially short them. So it does introduce a little volatility, but you ultimately own the shares for 5. And when the shares reach 40, incidentally, if you bought for 10, you make 4x or whatever. And if you bought for 5, now you're making 8x. So it's a huge difference when you lower that denominator in your IRR calculation. The third bucket is it goes up a little bit, and that's actually okay as well. So if it expired and the shares were at 12, we might get another chance to sell more contracts, and that'd be okay. We make 100%. The market was up maybe 20% from 10 to 12. So that's the third bucket. The fourth bucket, which bothers me quite a bit, but doesn't really bother any of our LPs, is that we were very right. Shares immediately go back to 40, and we make 100%, but buying the shares would have given us 300%. And of course, you don't hear many complaints about it, but that's an unfortunate scenario as well, because you do miss the upside. And so that's sort of where you can go right and wrong, and at a very high level how it works. You do want to be very careful. Each option represents 100 shares. I use these like a sort of pork belly future where I actually want the delivery of the pork belly. And I think that's a very safe way to sort of utilize these, but you just need to be prepared to buy the things that you are committing to purchase, or you can find yourself in some trouble.
So hopefully it's a little bit clearer there after Matthew Peterson's great explanation around selling put options. But just to summarize, so basically what it means when I say I will write or sell a put contract means that I will buy a certain company at a set price, also known as the strike price, at a certain date in time. And this could be 1 month, 2 months, 3 months, even 1 or 2 years away into the future. It means that I will happily pay that strike price at that point in time. So when I sell this put contract, I will receive a premium for writing that contract. Similar to insurance, think of it that way. Now there's a couple of different ways that this can play out. So the first scenario is that I've sold that put contract. Now someone will buy that contract and they will be paying me that premium in order to have that contract. Now let's say that share price does drop back below that strike price that I set. Then the person that brought that contract, they can force me to buy those shares at that price that I set. So that is one of the scenarios. So the second scenario is that the share price never gets back to that strike price that I set, and it just keeps going up or doesn't drop back at all. This would mean that the contract would expire worthless, so nothing more would happen. The only thing that would happen for me is I would still receive that premium. Like I was saying earlier, this is how we can generate an income from selling these put contracts. There's one more thing that you want to consider when you're selling put options, is that the share price may never get back to that strike price that you set. And if you really understand this company and you're really bullish on this company long term, you may never put these contracts to you. And if you really were wanting to take a position with that company, you might be better off just to buy some shares as well and use this as more of a strategy to add to that position over time if the price does drop back to that strike price that you set. Because, like I said, the price may run away from you and you may never actually get to buy shares within this company. So that's something you've just got to be wary of as well. So there we have it, guys. Just a very basic overview today on selling put options. If you've got any questions on anything I covered off today, drop it in the comments below and I'll do my best to sort of help you out. As I know the first time when I started learning about selling put options, my head was spinning a bit. So I know it can be a bit to take in. I will be making a follow-up video to this video where I actually do a walkthrough selling put options through the platform Interactive Brokers, which is the broker that I use to sell put options here in Australia. So if you're interested to see that and you're not a subscriber, make sure you hit that subscribe button. That way you can stay up to date when that video drops. But till next time, stay safe and we'll catch you in the next video. Cheers, guys.